Hello, and welcome everyone. Today we are deep diving into the 7 crypto tax loss harvesting traps that wreck your Canadian refund. And these past 2 weeks, I have been getting a flood of questions from Canadian crypto investors about whether their losses will actually lower their tax bill. And you know what? This isn't random. I've seen these spikes across my YouTube comments and all my client emails. Everyone wants to know how to do this cleanly before December 31st. So today I'm going to break down Canada's crypto tax loss harvesting rules through a clear, practical lens, including the one rule that quietly denies more losses than people actually realize. And today you're going to find out exactly what counts, what gets rejected, and how to avoid those traps. Hi, I'm Charlene Tessier, your Canadian crypto tax expert, and every week I help crypto investors file accurately and avoid CRA problems. Now, this video is for educational purposes. Everyone's tax situation is different, so always speak to a professional about your specific use case. Okay, you ready? Let's get started. Now, before we jump in to examples, let's take a quick refresher on the tax loss harvesting rules. So in Canada, you can use your crypto losses to offset your crypto gains, but only if the loss is considered real by the CRA. And the rule that makes or breaks everything is the superficial loss rule. So in a nutshell, here's how it works. If you sell a token at a loss, but you buy it again inside of the 61-day window, that's 30 days before the sale and 30 days after the sale, the CRA can actually deny your loss. And in my original tax loss harvesting video, we break down all the full definition and how those regulations work. So you can check out that video in the description below. But for today, I'm just going to focus on some real life examples because this is where most investors get tripped up. Now, I see these patterns every single year when I'm preparing these crypto taxes. So these examples come straight from real investors. All right, let's start with the win because honestly, after looking at so many of these messy portfolios, I want to start with something clean and something that feels really good. Let's see if I got this up here. Here we go. Meet Sarah. She bought 1 ETH on November the 1st and she sold it on December the 10th at a loss and didn't touch the ETH again for an entire 61-day window. No buys before, no buys after. The CRA looks at this and goes, yep, valid loss, nothing fancy, nothing tricky here. This is exactly what the rule was built for. So Sarah is our baseline. Now let's take a look at Jason because Jason is the Canadian crypto investor in all of us. Now, Jason, he sold his ETH at a loss on December the 10th. That's all fine. But then the market dipped and then Jason did this. He bought on December 20th. And that one little move wiped out his entire tax benefit. The CRA sees that repurchase inside the 30 days after the sale. And so, unfortunately, his loss is denied. So this is by far the most common real world example I see. The emotional dip buy that cancels the loss. And before we move on, take a second and think which of these examples feels more familiar to you. Sarah's clean win or Jason's dip buy? And just let me know number 1 or 2 in the comments. I would love to hear from you and I'd like to know what examples people are really connecting with. All right, let's go on to the next one that catches even the most careful investors. This is Priya's situation. And Priya is a great example because she didn't buy the dip and she didn't panic. She didn't rebuy anything. Her mistake was before the sale, and that's the part that almost everybody forgets. She bought 1 ETH on December 1st, and she sold that same ETH at a loss on December 10th. And she thought she was in the clear because she didn't buy after. But the CRA counts the 30 days before the sale too. So her December 1st buy is inside that window. And so that loss is actually denied as well. Now, Priya thought she was being really careful. And unfortunately, she just wasn't really looking at the rule in both directions. So let's now balance out an example with something positive again, because not all of these are bad news examples. So we're going to take a look at Marcus. He is one of my favorites because he busts a huge myth. So Marcus buys 2 ETH about a few months ago. And he decides long before the tax season that he's going to sell one. And then he decides to sell his ETH, one of those ETH, on December the 10th. And he decides to keep holding the other one. There's no repurchases inside the 61 days, just this one sale. So what does that mean? The loss is allowed. And a lot of people think that you have to sell all of your tokens in order to claim your loss, and you don't. The CRA doesn't care about all your older holdings and what holdings you have. They only care about those new buys inside of that window. So Marcus's sale and loss is allowed. All right. Now let's take a quick break here and take a look at which of these examples, the 4 we've just covered, surprises you the most. And let me know number 1, 2, 3, or 4. And this really helps me to actually understand which case examples are resonating the most with you. All right, next we're going to talk about Anna and automation. So Anna sold her ETH at a loss on December the 10th. But on December the 12th, her bot buys the ETH back again. So she forgot it was still running. And honestly, this happens a lot. The CRA doesn't care who pressed the button. If the bot buys it, they treat it exactly like you bought it. So unfortunately, Anna's loss is denied. And the lesson here is before you're going to do any tax loss harvesting strategies, you want to turn off all those automated buys and bots. Once that 61 days window has passed, you can, of course, turn it all back on. Okay, so let's shift gears a little bit and take a look at this example because it feels like it could be a loophole, but unfortunately, it's not. So this is what Ben did. Ben decided to sell some ETH on Kraken. No problem, that's great. But then he decides December 20th to rebuy it on Coinbase, thinking, hey, it's a different platform, so I can get away with this. But CRA doesn't see these as different doesn't care about the different platforms. They just care about the asset. So ETH is ETH, whether he bought it on Kraken, Coinbase, or ShakePay. It really doesn't matter. He repurchased inside the 61-day window. That means the loss is denied. And this is the one that among many people, they get tripped up because they are using many different exchanges and they just think that, hey, I can maybe manipulate the situation by just moving from one exchange to another. One more question for you guys, and which scenario trips people up the most that you think? Is it the buying the dip, the before sale, buy before sale, the bots, or maybe even the exchange switch? Let me know in the comments. Okay, we're just about finished. We've got one more. Now, this one is a little bit different. It's not quite an example. It's a bit more of a clarification because it comes up all the time, especially people who use DeFi or other staking. A lot of people ask, if I sell ETH and then move it and I happen to have a staked ETH or a wrapped ETH, aren't those tokens technically different? And yes, they are. On the blockchain level, they're different. But even selling ETH and buying some ETH again doesn't give you back, of course, the exact same token. But for tax purposes, the CRA isn't looking at those tax IDs. They're just looking at your economic exposure. So whether it's wrapped or it's staked ETH, all of these variants all give you the same exposure to the same underlying asset, which is ETH. So even though the names and, of course, smart contracts are different, the CRA does treat them as identical property. So the key takeaway is if you're trying to avoid repurchase, you need to just avoid all those variants as well. Whew, I don't know about you, but that was a lot. All 7, we got through those examples. And you can probably see now how it's really easy to accidentally deny your own loss, even when you think you're doing everything right. So I want to make it real simple for you and give you 3 steps to help keep this all clean and easy. First step, here we go. Turn off anything that can rebuy for you. So before you sell anything, pause all your bots or anything drip feeds into your crypto portfolio, right? If it can buy it for you even once, it can deny the whole loss. So this is the biggest protector of your tax planning because automation is, to be honest, one of the silent rule breakers here. 2, check that 61-day window. Look back 30 days, look forward 30 days. That's the entire danger zone. If you bought the same asset or an identical property like a staked ETH or wrapped ETH anywhere in that window, the CRA can deny the loss. So you don't need to calculate anything fancy. Just check your buys. If something is in that window, plan around it. Third step, look for losses you can safely harvest in other parts of your portfolio. Now, this is the part most investors overlook. You don't have to harvest losses in the exact same token you're selling. Sometimes the cleanest move is to look at the rest of your portfolio and ask, what else is underperforming? Maybe you have some altcoin that's never going to recover. Maybe you're holding a token you don't really believe in anymore. Or maybe you've got some NFTs that are really going nowhere. So give those failing assets one last job to do. Realize the loss so you can apply it against your gains. And it's cleaner and safer, and it avoids all the superficial loss rules headaches. And it still lowers your tax bill. And don't forget, any losses that you claim now, you can actually carry them back 3 years or forward indefinitely. So when you follow these 3 steps, turn off those bots, check the 61-day window, and use losses you can safely harvest, you don't need to stress about the superficial loss rule. You can stay clean, you can stay compliant, and your tax planning will actually work the way you intended. I know crypto can get really complicated fast, but the underlying principles don't really change. Every December, I see the same pattern. Good investors with good intentions accidentally tripping over the rules that were really never designed for crypto in mind. And that's what I focus on in all my work, helping Canadian crypto investors feel safe, informed, and in control, even when the rules feel messy. And if you stick around here, I'll be breaking down all of this so that you don't have to figure it out alone. And if you want to stay ahead of the Canadian crypto tax rules, my weekly Saturday newsletter breaks it all down in plain English, what's changed, what matters, and what you can safely ignore. And when you join, the first resource you're going to get is this one. You'll receive my Canada Crypto Tax Guide that has been updated for 2025. Walks you through the most common taxable events, reporting essentials, and all the rules every Canadian investor should understand going into the new year. And the link will be in the description below. Till next time, I'm Charlene Tessier. Here's to more crypto profits minus the tax stress.